Good morning, good afternoon, Happy New Year, and welcome to Axiom's annual update webinar. My name is Lindsay Chamberlain, Managing Director of Client Partnerships. Today, I'm joined by three of my colleagues: Founder and Chief Investment Officer Andrew Jacobson, Emerging Market Equity Portfolio Manager Jose Morales, and Small Cap Portfolio Manager David Kim. Today, we're going to provide a brief update on Axiom and a recap of 2022, and we're going to focus primarily on our portfolio positioning as it pertains to our outlook for the year ahead. As many of you are aware, Axiom is an independent, investor-led global equity investment manager. We have a firm-wide, consistent investment philosophy and process across all of our strategies. We've been partnering with professional investors around the world for over 25 years. Our client base is diverse and growing, with representation across 18 countries. Despite the market challenges in 2022, Axiom had strong positive net inflows, and that came from both existing investors contributing additional capital, as well as additional new client partnerships. We ended the year with over $17 billion in assets across 515 client partnerships. Today, our webinar will be structured in three sections. Andrew will cover a macroeconomic backdrop and focus on the positioning in our global all-cap strategies. Then Jose will expand on Andrew's comments with a focus on emerging markets. And last but not least, David will focus on the small cap universe of opportunities. Andrew, we'll start with you. Axiom manages over $7.5 billion of assets in our global all-cap equity strategies on behalf of 140 investors. Markets were volatile, to say the least, in 2022, and we saw numerous macro headwinds affecting a variety of different markets. I'd love to start with your perspective on the current economic backdrop.
Thank you, Lindsay, and of course, thank you to our clients for their continued support. As you mentioned, of course, markets were very volatile in 2022. It was a challenging period for growth investors and for equities in general, notwithstanding the recent turbulence, as well as the various growth and value rotations over the years. We've been able to achieve net of fee outperformance on behalf of our clients really since inception across all strategies, and of course, that remains our focus in the current environment. With regard to the current environment, clearly we're coming off of a year that was characterized by many different kinds of macroeconomic shocks that represent a challenge for bottom-up stock pickers like Axiom, the continued lingering effects of COVID, global supply chain disruptions exacerbated by COVID-0 in China, the Russia-Ukraine shock and the effect on some of the extractive industries and commodities kind of extending and intensifying the inflationary pressures early in the year, and then a historic tightening cycle globally with the strongest tightening, for example, by the Fed, really in over 40 years since the early 1980s. In that context, we've seen a real derating in growth stocks. Some of the value stocks were lifted by the strength in energy and materials, particularly early in the year. What that's meant as the year has progressed is growth stocks are returned to historically attractive levels, particularly Axiom's portfolios across really all strategies are trading at levels that historically have proven to be attractive. As you know, we have a very robust framework for monitoring macroeconomic data in over 100 countries around the world. We captured over 15,000 underlying fundamental data points last year. That's about 15% of the total data that we captured, reflecting our focus primarily on bottom-up stock picking, but wanting to have the macroeconomic context. We consolidate all of that data into the heat maps and graphs of inflation and growth trends globally that you see on the screen currently. And one thing that we're very encouraged by and gives us confidence about the forward-looking outlook for growth stocks is the inflation pressures, which really began to intensify back in 2021, have shown real signs of moderating recently, really bottomed out last summer, and we've seen a more consistent pattern of stabilization and recovery. In many cases led by emerging markets, which were often the first in and are now proving to be the first out. For instance, Brazil now has lower inflation than either Germany or the US, which is a striking fact. As recently as this week, China actually showed some deflation in certain commodities. And so that stabilization in inflation tends to be a more favorable condition for growth equities, particularly given how much valuations have come down. Regarding global growth, while there has been a moderation in global growth, the reopening in China is creating strong tailwinds in that economy, the strength of the US consumer, the fact that Europe has actually avoided the worst of the energy crisis, which was very much feared, and so we're hearing from our German companies that they're actually encouraged by recent developments. All of those are consistent with the idea that while growth is slower, it's at a level that was in evidence in 2019 and 2020, which was favorable, frankly, for the structural growth companies that are able to withstand a cyclically more moderate environment and still deliver healthy earnings growth. In fact, if you look at global growth forecasts for 2023, growth stocks are now forecast to have 10% higher earnings growth in value stocks, which really represents a re-expansion and a re-acceleration in earnings growth for growth stocks relative to value after a period of time where the value sectors were helped by things like the commodity shocks. Having been through many rotations over the years, one thing that we've really learned is during these moments of dislocation, it can be a great time to deploy capital into these higher growth companies, capture them at a moment of moderate valuation and moderate expectations when actually their businesses are showing early signs of reacceleration. And so that's something we've been very focused on recently.
So you mentioned that you've been through many of these rotations in the past over your career. I'm curious about how the more recent rotation might compare or contrast to prior rotations.
Sure. One thing that's been a feature of the recent rotation is how sharp and severe it's been. And so what, again, you see on the screen is a history of the growth and value rotations for our longest standing strategy, our international equity strategy, which goes back now over 25 years. And just to summarize what you're looking at, when the line is green and above, it's green colored, that means growth is outperforming. When it's red and below, it means value is outperforming. And then the line graph is just Axiom's net of fee outperformance relative to our benchmark, ultimately the value added that we achieve on behalf of our clients by sticking to our forward-looking dynamic growth process. This recent rotation, as you can see, has been really the sharpest one we've seen in over 20 years. That's meant that the valuations for many of these high growth companies have reset abruptly from levels that were maybe a little bit elevated to historically attractive levels. We've certainly seen that for our own portfolios. What that's meant is having reallocated away from some areas like emerging markets, like technology and internet and some of the higher growth medical specialties back in 2020 and 21 when we saw the signs of inflation accelerating. Because of the severity of this correction, it's presented opportunities now to reallocate back into these companies. Some of that capital went to fund additions to our stable growth companies in industrial services, in consumer staples, and branded consumer goods, some of the more resilient parts of the economy. Those stocks in many cases have performed well, and we're now using those stocks as funding sources in order to allocate back into what we think will be very attractive medium-term opportunities in these higher growth areas, including in technology and emerging markets and some of those other sectors that I mentioned.
Well, I think that's a perfect transition over to emerging markets. Thank you, Jose. The emerging market investment team manages approximately $8.5 billion on behalf of 175 investors. So I'm sure our clients are wondering if you could expand a bit on Andrew's comments and share a little more about the challenges in emerging markets in 2022 and what you might be excited about in 2023.
Sure. Well, thank you, Lindsay. After a very challenging year for emerging equity markets in 2022, we're actually very excited about how emerging markets are set up for 2023. For starters, some of the key headwinds that we saw for emerging markets last year are now turning into tailwinds for this year. So, for example, the U.S. dollar. The U.S. dollar was a major headwind for emerging markets. Obviously, we saw the strength that it exhibited last year. The real effective exchange rate of the U.S. dollar reached a 28-year high. For 2023, however, expectations are that the U.S. dollar will weaken in line with the disinflation trends that Andrew highlighted a little while ago. And so as that disinflation trend continues, we would expect for the U.S. dollar to continue to weaken, and that would be supportive for emerging markets. The other point that I would highlight as well is the GDP growth differential between emerging markets and developed markets. And this is important because when you look at the performance history, what you find is that when this differential widens out, in other words, emerging markets growth starts to outperform relative to developed markets, then emerging equity markets also tend to outperform developed equity markets. When you look at the chart, what you'll see is that the last time that emerging, sort of versus DM gap widened was in 2020. That was also the last year that emerging equities outperformed developed equities. And so this is going to be another, when you look at the chart, what you'll also see is that the expectations for this gap are to widen for 2023 back to about 3.5% or so. So that's going to be another positive driver, we believe, for the relative performance of emerging equity markets. Another key headwind for 2022 was China. And again, it's another example of one that we believe will become a tailwind for emerging markets in 2023. Now, as we all know, the economy has opened and shut down for much of the last 3 years, as the authorities in China have remained very committed to the zero COVID policy. Now, this is all changing. We're seeing some very concrete steps that the Chinese authorities have moved on from zero COVID and are in the process of completely reopening the economy. Now, much like we observed in the West, we'll see some initial spikes of COVID cases and a few waves, but ultimately, the full reopening of the Chinese economy is a key positive. It's a major positive for not just China, but also for emerging markets more broadly. And if that wasn't enough, what we're also seeing is that there is a change in policy with regards to the Chinese tech sector, where they're moving away from this very sort of strict, sort of regulatory grip on the sector to one that's more supportive. And so what that's presenting to us is a host of opportunities, primarily initially in this sort of consumption space and domestic travel, but we expect for that to broaden out as the year goes on. And so, this then takes us to valuation, and in particular relative valuations between emerging markets and developed markets, which historically have always been at a discount. But where we are today is that the discount is much wider than its historical average. So today, the emerging equities are trading at about an 11 times PE forward. And when you look at the chart, what you're going to see is that that's currently at about a 1 standard deviation below its 10-year average. So, a pretty attractive entry point from a relative valuation perspective for emerging markets. But, valuation in and of itself is not a catalyst. Obviously, in addition to some of the key points that I just raised with regards to macro and policy changes, as well as in addition to the fact that, foreign ownership of emerging markets is at a decade low, emerging markets are actually presenting some very attractive bottom-up stock-specific opportunities, which, now takes me to my last point, and that is that, we've seen a pretty tremendous, change in the investment universe in emerging markets over the last sort of 10 to 15 years, where, we've seen old economy type of sectors essentially give way to more innovative, new economy sectors that offer, access to underpenetrated sectors, areas such as consumption, such as financial services. I mean, some examples, we can go into sort of e-commerce, automation, this type of access is what's increasingly available in the emerging market space. But despite the fact that it's a very important part of the emerging market case, we believe that it's still, this sort of innovation economy is still an underappreciated opportunity by investors who are looking at emerging markets, because these companies are not only providing, these long-term secular tailwinds, they've been through a pretty tough couple of years where they've been, cutting costs, becoming more leaner, and just focusing on efficiency. And they're now in a position where, as the cycle begins to recover in 2023, they're in a position where they should see some pretty significant upside to their earnings as well.
Jose, I wanted to expand a little bit on something you said a moment ago. You mentioned China seems to be softening a bit in terms of the regulatory environment, particularly referencing the tech sector. Does the investment team trust that this more favorable stance in policy will continue in a positive direction for the stocks within these sectors?
Sure. Yeah, look, I mean, obviously trying to predict policy changes in China is a very daunting task, but when it comes to policy change within the tech sector in China, we're fairly confident that the changes are intact, and we would expect for that to continue. And a couple of reasons why. First of all, China needs growth, right? So growth has been under pressure because of this commitment to zero COVID, in addition to other factors. And so for 2022, for example, growth is expected to decline back down to about 3% or so. And so they really need to ramp that up. And they've acknowledged that they need the tech sector in order to be able to accomplish that. They've pretty much said so. So that's point one. point two would be that they are actually taking concrete steps. It's one thing to say something, to talk about it. It's another thing to actually make concrete steps, and they have effectively been doing that. So a couple of examples. Tencent, which had gone through an extended period where they had not received any approvals for gaming licenses. They more recently have started to see those approvals come through. A consumer unit with Ant Financial recently also received regulatory approval for a capital injection, which pretty much puts Ant Financial on track for a possible IPO. That's a major change from 2 years ago when this regulatory scrutiny started. And so, we believe that that's obviously something that would be supportive for the China case. But one thing that our clients do know about us is that, the Axiom process is focused on, monitoring the data points that give us an insight into what the trends are, both at the stock level as well as the macro and policy level. And so, for example, this is what enabled us to track the developments in Russia about a year ago this time, and led us to effectively exit Russia before the sanctions kicked in at the start of 2022. So it's with this same process, the same approach, that we will continue to monitor the forward-looking data points in China, that particularly with regards to reopening and the policy around the tech sector, and then make any changes as and when necessary.
And I assume with China often dominating the EM headlines, you mentioned tracking data points. Outside of China, are there other pockets of opportunity that you're really excited about for the year?
The good news is that it's not just about China, and that's what makes, I think, emerging markets exciting. So, staying within Asia, but outside of China, Southeast Asia, particularly Thailand, is a market that we have been focused on and are overweight and excited about. Obviously, it's a tourist-dominated economy and market. It's been part of the sort of global reopening theme, and will be a key beneficiary of China when its tourism goes from domestic more towards international. That's sort of later in the year. But a theme that we do continue to like in Thailand as well is the hospital tourism. So there's obviously the direct tourism, but the hospital tourism is also another area that we're excited about. Outside of Asia and moving over, let's say, to the Middle East, what we've seen there is an increasing number of opportunities. It used to be, sort of small markets, very liquid, not many opportunities. What we're seeing more recently, especially in the Gulf region, is that these markets are deepening, and they are diversifying away from the sort of oil and gas space, and their liquidity is improving. So we expect for that to continue and for there to be for more opportunities as we go forward. And then now moving to Latin America, we continue to like Mexico. It's a key beneficiary of the reshoring theme or the trends rather, that are taking place. And Brazil, Brazil is one that's a little bit of a wild card post the Lula election. So we have to see how the fiscal developments, again, we'll focus on the data points and seeing how those trends evolve. But for the moment, and as Andrew highlighted earlier, it was sort of a first mover with regards to monetary tightening and on this sort of disinflationary trend that is still supportive for growth. And so long as that continues, keeps Brazil, we believe, as an attractive opportunity. And then finally, I mentioned, the change towards a more innovative new economy type of investment universe in emerging markets. And that's also another exciting set of opportunities that we're identifying. Things from, fintech in Brazil, trailblazing sort of payments types of companies, to small cap companies in Taiwan that are focused on the digital space that we also think are very attractive.
Thank you, Jose. It's a perfect transition over to David Kim. David Kim is a small cap portfolio manager. The small cap team manages about $1.3 billion in assets across 100 client accounts. And David, we've certainly covered the broad macro, focused a little bit on emerging markets. Can we now touch on the small cap universe and how that's comparing to its large cap counterparts?
Sure, thanks, Lindsay. Global small caps are a really interesting area of the marketplace as we enter 2023, really for two reasons. One, as you can see in the chart attached, the valuations of global small caps are trading at a 15% discount to their general historic levels. In addition, the relative valuations between small caps and large caps are now showing small caps trading at almost a 20% discount to large cap companies. So attractive valuation, again, an evaluation reset given the volatility in markets last year is one important point. And the second is earnings growth. Small cap companies globally are expected to grow earnings by over 14% in the coming year, which is significantly higher than large cap companies. And so we think this combination of both attractive valuation as well as better earnings growth on a relative basis sets up to be a very compelling opportunity for small caps in the coming year.
Great. And going back to, we touch on positioning in each of the portfolios, but I'm very curious to hear about the interesting alpha opportunities you're finding in the small cap universe and how that's really playing into the positioning that you have going into this year.
Sure, yeah. There's been a number of opportunities that we're identifying on a bottom-up basis. The global small cap space is very broad in nature with over 6,000 companies to choose from. But broadly speaking, there's two areas that are really interesting to us as we enter the new year. The first area is with regards to high-quality small cap companies. Many of these companies, due to the market volatility that Andrew and Jose talked about last year, did not outperform. And so we believe companies that are executing on their business plans, that are exceeding expectations, remain very interesting areas of the small cap market, particularly in industrial services and healthcare services. These companies, we think, will start to reassert themselves as the markets move from a more macro focus to a bottom-up focus on fundamentals. The second area is as well similar to what Jose was discussing with regards to innovation. Small cap companies are a very innovative part of the global growth equity space. These are companies where primary growth drivers for these companies are not as sensitive to macroeconomic trends, and areas include things like electronic vehicles, advanced medical technology devices, industrial production and automation, as well as cloud computing. And these are some of the areas that the small cap strategies have been investing in and positioning in as we move into 2023. Another broad comment to make is the small cap team continues to consistently implement our investment process that's been time tested. Our focus on deep collaboration across our investment team, looking for insightful fundamentals across companies, industries, sectors, countries, and market capitalizations is a key feature, and we continue to focus on that. And we're very excited about the opportunity ahead.
Great. Thanks, David. And before we conclude the webinar, I have to ask Andrew one additional question. A couple of years ago, our clients and partners may recall we hosted a webinar where you really focused in on the structural case for growth equities. And you highlighted what you called the 4Ds. And given that it's been a couple years, we've had a large rotational market, and I was hoping you could give a little perspective in how the current market environment has impacted your original thesis from a couple years ago.
Thank you, Lindsay. So the 4Ds framework, just to refresh everybody, is growth is increasingly scarce in the world for a number of reasons that are very structural, that are likely to unfold over many decades to come, not just 1 year or 2 years, but really over an extended period of time, and can really create a framework for capital allocation with a longer term perspective. And essentially the four factors are demographics, deglobalization, debt and fiscal constraints, and then the effect of disruptive new technologies concentrating success into a more limited number of companies that are able to leverage those technologies. And each one of those 4Ds has actually been reinforced and intensified by everything that's happened during COVID. So demographics, I think everybody's aware that there's actually been an intensification of some of the aging populations and declining birth rates globally. Deglobalization clearly has been accelerated, and it's benefited some countries like Mexico, but broadly it's a headwind to global growth. Debt imbalances and the constraints of fiscal excess really are constraining future ability of governments to stimulate cyclical growth. And then the acceleration of the adoption of technology, and I think all of us know that from our own lives, how much technology adoption continues to accelerate and continues to impact both work and personal consumption. And fewer companies are really able to take advantage of all of those different elements. And the result of that is a smaller and smaller percentage of companies are capturing a disproportionate part of the global growth opportunity. Growth equities are poised in 23 to reaccelerate relative to benchmarks and value stocks. There could be as much as a 10% gap in earnings growth according to current forecasts. And that set of conditions really creates tailwinds for growth equity investors, both in the coming year as well as over the longer term.
Wonderful. Well, just thank you so much, Andrew, Jose, and David, for sharing your comments and insights, not only with me, but with our investors globally. On behalf of everyone at Axiom Investors, we just like to thank you for your continued partnership, and we wish you a very healthy and successful 2023.